Welcome to the Techno Fundamental Report on September the 7th. Techno Fundamental, what that means is we look at technical analysis, but we also look at fundamental analysis. We look at everything, anything and everything. So I just wanted to go back in history a little bit and talk about the crash of 1987. Stocks plunged amid panicky selling. Panic, Dow plunges through floor. I can remember this so well because I was sitting at my Bunker Ramo machine in 1987, and I had to ask myself the question, is this machine broken? Because things were dropping so dramatically. So the reason I'm bringing this up is that I've been talking to a lot of my technical analysis friends, and they really feel that where we are in 2023 looks very similar, or really 2022 and 23 looks very similar to 1988. So I wanted to kind of go back and refresh everybody's memory, just because there is a possibility that history does repeat itself. At least it rhymes. So anyway, you can see here on the graph, this just shows how dramatic the drop was. It was 25% in one day. That was pretty much unheard of. So crash of 87, if you go back and look at it, you can see here we launched that bull market in 1982, went about 5 years, had a major sell-off. So if you kind of look at where we are now, 5 years ago, well, basically we broke out. You see, the thing to understand here is we had a long consolidation period here. This was an extensive period. This was from 2000, did not break out to a new high until about 2014. And then basically the demographic studies also somewhat confirm this. And so there is a correlation with the demographics. Whether or not the human behavior side is going to correlate is the big question. So, with a long period of consolidation, we finally broke out, made a new high, got out of that consolidation, and like the crash of 87, we had a major sell-off here of about 25-30%. This was that magnitude. So maybe there's a correlation. Now, we have to remember that this is an auction process. This is an auction market. You have buyers and you have sellers. An auction market, in my opinion, is virtually impossible to predict. So you need a crystal ball basically to be able to predict it, but that doesn't work either. So the point being is you've got to just be patient, and the crash of 87 was difficult, but if you got through it, things worked out. Now, I also want to talk briefly about using your imagination. I can remember back when we first got the cell phones, and everyone said to me, I'll always have a landline. I'll just have the cell phone as my cell phone. But we all know, and we've all dropped our landlines and we've gone to cell phones. This is a humongous industry now. So you can't have a closed mind when it comes to this stuff. Now, what I'm showing you here is a picture of a robo-taxi. Now, this is artificial intelligence. This is where a robot is driving this car, driving this vehicle. So I talk to people all the time about it, and they go, well, I'll never use one. I would never get into one of those cars, da-da-da. Well, what if down the road, say 5-10 years from now, it becomes commonplace, just like the cell phone became commonplace? So keep an open mind. Now, I did want to kind of mention that interest rates have kind of popped back up here a little bit, causing the market to have some difficulties. In fact, the futures are down this morning, so we're probably going to have a down morning. It's been a tough week. Anyway, you can see here the power index kind of got below zero, now kind of popping up a little bit. Let's just see. We're keeping a close eye on interest rates. Now, the main thing, though, is the primary trend is still up. I mean, here we have the S&P 500. The 200-day moving average is in an uptrend. Here's the NASDAQ. Primary trend is up. So that's the good news. The other good news, I wanted to update the Copic curve because it updated at the end of August, and we've got a reading now of almost 14. So we're starting to see some headway on this Copic curve, which basically is confirming the fact that the market made a low at 3,500 in December of last year. Now, interest rates continue to be a problem here. This is a 30-day Treasury note or bill, and it's currently yielding about 5.5%. So people are, everybody I kind of talked to said, well, I can get, 5% on a CD and so forth. So this is creating, of course, competition for the market. Crude oil, we're starting to see crude oil kind of go into an uptrend here. You can see that it got above $85 a barrel on West Texas. Good news here is the aggression index is definitely in good shape. You can see back here when in 2020, which was a great year for us, for growth stocks, you can see the aggression index had a big rally, a consolidation, and then it resumed the rally. It looks like to me that's kind of a similar pattern here. So the aggression index is looking good. That's an important indicator. Again, our three economic indicators, you can see interest rates have popped back up again after coming down. You can see the price of oil is kind of breaking out. I think that's causing some inflation worries. And your financial stocks continue to kind of vacillate, not really seeing any headway there. We would really like to see the financials do better. New lows, you can see here on the New York Stock Exchange, we got some pretty high new lows here after a period of low new lows. So we're getting too many new lows. But you want to see that over a period of time. Maybe this is just a one-day event. Also, here is an industry ETF, which is for energy, called the XLE. You can see here how it is broken out and is in an uptrend. So the energy stocks is pretty much technology and energy is the two groups that look the best. Now, one of the groups that looks terrible is utilities. The utilities have really broken down, and they're somewhat of a bond tradable type of instrument. So when interest rates go up, that's going to hurt the utilities. So if you have any questions, let me know. Be patient. I think where the main primary trend is up, we're just going through a difficult correction. Let me know. Thank you.